Good evening everyone, and welcome to our market analysis report. Just yesterday, we witnessed a remarkable day on Wall Street, with the Nasdaq, S&P 500, and Dow Jones Industrial Average all closing at historic highs. The Dow even crossed the 50,000-point mark for the first time ever. However, in a swift turn of events, the market sentiment has dramatically shifted overnight. That fragile optimism we've been discussing appears to have been shattered, and we are now seeing a rapid transition into a risk-off environment. Let's look at the key data points that illustrate this shift. The VIX index, often referred to as the market's fear gauge, surged by 11.01% to 19.16. Simultaneously, the 10-year U.S. Treasury yield jumped by 2.31%, reaching 4.56%. Both of these movements, occurring in tandem, are strong indicators of a sharp increase in market anxiety. The U.S. dollar index, DXY, also saw a modest gain of 0.1% to 99.21, signaling a flight to safety into the dollar. Our core conclusion for today is a high-level correction, with a probability of 75%. The primary driver behind this is the higher-than-expected inflation data, which has led to a rapid reassessment of interest rate expectations. This, in turn, puts direct pressure on the valuations of risk assets that have been trading at elevated levels. The main axis of capital flow is now towards the dollar and energy. We are observing funds exiting both equity and bond markets, seeking the liquidity and safety of the dollar, while some capital is moving into the energy sector as an inflation hedge, fueled by ongoing geopolitical risks. From a global capital flow perspective, we see a blockage in the transmission of risk appetite, with a 70% probability. Asian markets have already confirmed a downturn, with the Shanghai Composite Index closing down 1.02% today. European markets followed suit, weakening during their trading sessions, and U.S. equity futures are currently under pressure across the board. Yesterday's optimism in the U.S. stock market failed to carry over into the Asian trading hours, effectively halting global risk appetite and feeding negative sentiment back into the U.S. pre-market. Breaking down the macroeconomic drivers, interest rates are a clear negative, with an 80% probability. The jump in the 10-year U.S. Treasury yield to 4.56% is a direct response to the higher-than-anticipated U.S. April CPI data. Market expectations for Fed rate cuts have quickly evaporated, and this higher interest rate environment severely suppresses equity valuations. The DXY, or dollar index, is trading at a high of 99.21, benefiting from safe haven demand and relative interest rate differentials. A strong dollar will naturally put pressure on non-U.S. assets and certain commodities. Inflation is the core logic behind the current market sell-off, with an 85% negative probability. The resurgence of inflationary pressures directly leads to stronger interest rates and a stronger dollar, making it a common enemy for all risk assets. Geopolitical risks present a dual effect. The ongoing tensions in the Middle East provide support for crude oil prices, but they also exacerbate overall market uncertainty, contributing to the rise in the VIX index. Regarding core assets, U.S. equities are facing a high-level correction, with an 80% probability. Under the twin pressures of a VIX at 19.16 and the 10-year Treasury yield at 4.56%, high-flying tech stocks that hit record highs yesterday, like the QQQ, are now facing the most direct profit-taking and valuation adjustments. A-shares, with the Shanghai Composite and CSI 300 down 1.02% and 1.12% respectively, are being dragged down by the deteriorating global macro environment and declining foreign investor risk appetite. Bitcoin, currently trading around $80,113, appears stable for now, but as a high-risk asset, it will likely face institutional capital outflow pressure under tightening macro liquidity expectations. Even if it currently seems decoupled from the broader market, downside risks are accumulating. Commodities show a structural divergence. Gold, trading around $4,548 an ounce, is under pressure due to the stronger dollar and rising real yields, while crude oil, with Brent hovering above $107 a barrel, is receiving a premium due to geopolitical factors. Therefore, the main capital themes for today are quite clear. First, shorting high-valuation growth stocks. The direction is bearish with an 85% probability and strong continuity. The 10-year Treasury yields jump from 4.4% to 4.56% directly impacts the valuation of growth stocks, which are highly sensitive to future cash flow discounting. Capital is expected to continue flowing out of the tech sector. Second, positioning in the energy sector for hedging purposes. This direction is bullish with a 65% probability and medium continuity. Brent crude oil prices remaining above $107 indicate persistent geopolitical risk premium. In an inflation trading environment, funds will likely allocate to energy stocks as a defensive and hedging tool. Key high-frequency points to watch include whether the 10-year U.S. Treasury yield can firmly hold above 4.6%. If it breaks and sustains this level, it could trigger further algorithmic selling in equity indices. Also, the VIX index is currently at 19.16. If it breaches the 20 mark during today's trading, it would signal a shift from concern to panic, potentially accelerating the sell-off. Of course, potential risks that could reverse this trend include an unexpectedly dovish statement from a key Fed official, or any concrete news of de-escalation in the Middle East conflict, which could lead to a rapid pullback in Treasury yields or a sharp drop in oil prices, respectively. In summary, our strategy for today leans towards hedging, with a confidence level of 0.80. We project a 75% probability of a down day for the market. In this complex and uncertain environment, investors should remain highly vigilant, monitor key risk indicators, and manage their exposures accordingly.